We are live. Welcome to the November 2nd Portfolio Builder Premium live webinar. If you're on a free trial, you get to test drive our high risk, high return portfolio, now up 323% year to date, outperforming the S&P 500, which has been doing spectacular 15 times. Quick shout out to the live crowd. A lot of people joining in as I'm speaking, but we have live Alray, Barb, Calvin, Clarence, Clifford, Edgar, Gary, GVAS 2016, Henry Wong, Iron, James Goodwin, James Robertson, Jan, Jason, Jeff Olson, Jeff Friedman, calling out of Israel, Jeff in Colorado. Spoke to both of you guys yesterday live, one-on-one. Jenny, Jody, Cam, Ken, Kevin, Nell from Europe, Orlando, Marty, Michael, Mike, Mims, Mongo, My Downtown 30, Murray, Neil, Pat, Peter, Randy, Reggie, Rick, Roanne, Rob, Ron, Sam, Yao Sung Tung, and Johannes. So welcome all, and let's go ahead and hop in today's content, a breakdown of the 4 strategies we offer. We've got the high risk, high return portfolio currently up 2% November. This is a creation of my own, just putting the pedal to the metal with the most aggressive strategy we can possibly put together. That's not trading meme stocks or anything silly like that. Still looking at critical assets that have sustainable growth underneath them. Then we have Safe Alpha. I call that the Warren Buffett on steroids strategy. He's big on Apple and banks. We're big on the tech sector and energy. It's a growth to value strategy that's American focused, up 2% in November. Really great return last month for Safe Alpha. We've got the Safe Growth Pro. This is the Ray Dalio strategy, also on steroids. He's a big fan of being extremely diversified with a global portfolio. He's huge on China and Asia in general as the best returning asset class of this decade, which I would concur with, even though we haven't seen that come to fruition just yet, up 1.2% in November. And then if you want to combine the Safe Alpha and the Safe Growth Pro into a hybrid strategy, that's still aggressive, also a creation of my own. We call it the Bootcamp Core, up 2% in November, coming off a red hot 20% gain last month as well. So those are the 4 strategies we publish, and excuse me, on the year up above 2021. Okay, so stock buyback melt up, dead ahead is what we were saying last week, and that continues into this week. We've got retail mania. We've got Elon Musk poking fun at the globalists, which is just continued to just drive massive call options, driving Tesla to extreme highs. This morning, we've got all sorts of Russell 2000 companies doubling and tripling. So the market mania remains intact. And we're issuing a red hot buy trade alert for all strategies. Now, remember, if you're on a free trial, you get the high risk, high return formula. The second you upgrade, you'll get some of our other strategies. And the main difference in each program is the size of the market we're targeting. That's how we're going to control the amount of risk. So to put things in perspective, high risk, high return has a huge bet in Ethereum, a cryptocurrency we believe could overtake Bitcoin if the right things happen. A big bet on rare earth metals and a big bet on oil and gas. Very targeted bets, and it's done extremely well. And again, we're not playing meme stocks, meme cryptos, anything silly like that. This is very serious investing, just targeting smaller market caps. If we go to Safe Alpha, we're playing the US stock market. So about a $30 trillion total market. If you go to Safe Growth Pro, we're now playing where the uber elites have their assets saved, which is a global strategy. It's over $124 trillion global stock market. Okay, so that's how we control risk. We have the same methodology and strategy. We're just zeroing in on bigger or smaller markets to control risk. So once again, if you want to diversify, the second you upgrade, you'll gain access to all of our services. Now, at the end of the video, I will cover exactly the trading formula for each strategy. We all follow the same ratio of shares of each ETF, so we all get the exact same return. And that's really what's so popular about this product. So again, I'll cover that at the very end after we go through charts, data, and news. Now, if you're catching this on YouTube with a remarketing ad, you're not going to get the critical ending where I reveal the exact trading formulas. So just keep that in mind and call Dean at 505-322-7515 so he can sign you up and get you access to the membership area. Now, the membership area, I'll just hop off really quick and give you a teaser, actually has all of our formulas in one spot, and you just punch in how much money you want to invest, and it automatically takes the total to invest, divides it by the unit cost to build 1 unit of each strategy, and then multiplies it across the ratios and prints you out exactly what to invest. So we have all of our strategies lined up right here. You'll gain instant access to this the second you upgrade. So very good. Call Dean at 505-322-7515 to upgrade your membership. All right, so what's happening? We've been predicting that in general, we're going to have a stock, crypto, and commodity melt up all the way until mid-November. And we were preaching this even during the small pullback in September, which was due to the debt ceiling crisis. The debt ceiling crisis is going to be here in no time. Once again, December 3rd is the deadline. Joe Manchin is digging his heels into the ground. Jayapal sees the opportunity to potentially overtake leadership of the Democratic Party. Nancy Pelosi is losing control of the House. So we're going to get more defensive if we don't see considerable progress on the Build Back Better agenda within the next 2 weeks. We'll probably top up a little trade alert tomorrow to get a little extra UVXY because we have the tapering announcement tomorrow. Now, here's the big thing that's going to affect global markets is whether or not Biden's Build Back Better plan is passed. We had Bill Gates post a Twitter thing saying he hopes the Build Back Better agenda gets passed. Of course, he's the one who probably wrote the majority of it. And so far, no progress is really being made. Lots of hopeful little headlines being thrown out, but so far, no luck. So this is going to become more and more problematic. Now, if it is passed, I believe the stimulus will be plenty to keep the market melting up through March and some point into Q2. After Q2, we got to realize there's a dreadful fiscal cliff coming our way. So the rate of government cash injections into the economy is going to slow dramatically. And without a massive recovery of labor markets, it's going to get volatile for sure at some point next year. Now, if they can't pass the budget, we're going to have problems much sooner. I'm talking about in the next 2 to 4 weeks, I'd anticipate significant volatility. So we'll be ready and of course are following this. Failure to pass the budget will result in another debt ceiling crisis, and it's by December 3rd, actually, not December 4th. So will McConnell throw the Democrats another bone and give them another $500 billion of debt ceiling increases if they don't get their act together in November? We will see. We shall see. But in general, we got to realize Democrats do control all 3 branches of government. And it would be shooting themselves in the foot to create an economic crisis right before Christmas, as we have supply chain issues, inflation, and very, very poor polling for Mr. Biden. So they really can't afford a big crisis right now, in my opinion. And I think they will pass this budget. So we've been sticking to our guns, remaining long on the inflationary plays. That's been very profitable thus far. Now, another key risk ahead is the Fed tapering announcement, which is supposedly tomorrow. This is in the face of a slowing economy, and we're seeing a lot of disruptions in labor markets. Now, he's going to have to make this announcement tomorrow before getting the jobs data on Thursday, which I think will come in relatively weak due to all these mandates that are causing disruptions. We've got all the airlines are in a frantic state saying that the wind is canceling airplanes. We know that's really not the case. We've got all over the economy. There's all sorts of shutdowns due to these mandates. So I think the likelihood of a red hot labor recovery in the last month is very slim. So we will see. Now tapering is just slowing down. We got to realize with the current projected tapering that's been sent to us through all the media outlets, the plan is to stop printing money as far as quantitative easing goes by June. And now the bond markets are pricing in a first rate hike in July. Now, so that's aggressive, and we will see if that really plays out. And that's going to be the single most important thing that's going to affect markets and how they behave, is what the central bank in the United States is doing. So we'll keep a close eye on it. Will Powell wait until December? The FOMC minutes from last update did have the ability to do it in November or December in the wording. So I'm not so sure he will begin it this week, but we will see. Now, what's the reaction going to be of slowing down quantitative easing? You would think that in general, that interest rates would slowly start to rise, and that we would start to force a growth to value rotation and not get an immediate stock crash led by commodities falling. So that's what my best guess is how the market will respond tomorrow. We'll look at some more data on that. Then the final wild card is that the medicine to treat the global sickness is not working after 4 months. This is very clear without the booster, and not many people have taken the booster. We're also getting pretty clear evidence that the medicine is confusing the immune system and preventing a long-lasting immune response. So my prediction is that we're going to see overloaded hospital systems at the very end of November and especially through December in the United States, and that this could create a lockdown risk, which would make the price of oil crash. It would slow down this inflationary impulse and potentially be used as a political weapon to help force this budget through. So if we don't see a budget passed by mid-November, and we start to see the hospital beds are getting overloaded, look for the risk of lockdowns to help push this Build Back Better agenda through. So I think no matter how you skin it, one way or another, the budget's going to pass. There's going to be a massive fiscal impulse into the next year. So any kind of volatility event to close out the year is a buy the dip opportunity, in my opinion, because it would be suicidal to the Democratic Party to not pass these different budgets, to give them a chance at midterms coming into the end of 2022. Now, again, if they fail to pass the deal by, I'm now thinking mid-December, look for volatility. And so that's what our UVXY position does for us. It can give you 1,000% return if you get an extreme panic in the markets. Now, the markets are extremely over leveraged compared to 2020 of March, where we did predict the last volatility event. And I just want to let you know, if you had a 10% position in UVXY last March, 90% of your portfolio could have gone to zero, and you actually had a 10% return at the peak panic period without touching anything. And then, of course, everything rebounded as the Fed went into super aggressive quantitative easing, lowering interest rates, and the US government passed trillions in spending. Okay, so what am I looking at to predict problems? First and foremost, I'm mainly watching the price of oil. I think that'll be our single best indicator of problems ahead, especially for the US. I'm watching the price of the dollar, but we got to keep that in mind, as that's going to potentially be spelling out weakness in Asia, which this stimulus could really fix, because we do import most of our goods from China. So we're watching DXY, that's the dollar against the euro primarily. If it goes over 94.50, that's definitely a massive warning sign coming through of weakness somewhere. Someone's driving up the value of the dollar against other currencies, and that's telling us there's liquidity problems in the financial system. Okay, so if I were to see the dollar rising and oil falling and bonds going up, that would really get me worried. Today, we have an interesting combination. We've got the bond market yields falling, especially on that 2-year that had this shock earlier in the week due to Australia letting go of yield curve control. So we've got the bond yields falling. We're going to be more worried in general about bond yields rising. Okay, that's what I think could actually create a stock crash. And I think it's going to not happen for quite a while, not until stimulus is passed. So if the TLT were to fall below 140, big red warning sign. Today it's up 0.4% and it's trading at 147. So we don't have any kind of worrisome problem from interest rates becoming so attractive that they're going to start disrupting markets. Instead, we have a bid for treasuries. We've got the DXY at 94, so it's up 0.2. 94.50 is a technical resistance level. So it's been flirting on that. I believe the second stimulus passes, DXY is headed towards 90 to 89. And that'll be a good time to take profits on just about everything that we're long and get more defensive. So that could take months to occur and is going to be the result of massive stimulus getting passed. So the returns we've had with the dollar in general rising over this period are quite remarkable. Just wait till that dollar falls. I think you're going to see some of the best returns we've had in the history of Portfolio Builder. Emerging markets, we know China has been doing all sorts of, they call it smash and grab, smash your own assets down as a government and then grab them up cheap. Not going to spend too much time talking about why they're doing it, but they certainly have. And if EEM were to go below 48, that's a big warning sign. Today it's at 50.83. It's down 0.96%. It was up yesterday. Emerging markets does not like the dollar going up, so that makes a lot of sense that it's down slightly today. Brent oil is at 84.39. So we got the dollar rising and oil rising, telling you foreign currencies are very weak right now. So again, we're nowhere near 75. So the energy crisis continues. A lot of these big banks are predicting oil to go parabolic into winter due to extreme cold weather, people switching from natural gas to oil. And just in general, we've printed trillions of dollars, flooded it into the economy, and now we're slowly getting back to normal. So the demand levels are coming back, and this is creating energy crises all over the place. NRGU, our oil play, could be going up significantly from here. Finally, if China is about to crash because they're letting all these bubbles burst, specifically their real estate, then we're going to expect something to crack over there, either their bond market, stock market, or currency market. And so there's no signs of that. We have the USD CNY, or the dollar against the yuan, trading at 6.399. And in general, that's been strengthening. For the past year, it's fallen from 6.7 conversion rate to 6.4. So becoming extremely strong due to massive exports. So they've had one of their best years yet. So no reason to get concerned there. We're nowhere near a line in the sand for the yuan devaluing. So really looking good. If you had to boil it down to one indicator, I would say oil selling off is going to predict a deflationary spike in the economy. And most likely what we need for a crash right now would be failure to pass the reconciliation and infrastructure bill, and that led to a lockdown. You do both of those, and I'm sure you're going to get oil to tank. But my core prediction remains that we will have a slow motion multi-year rotation out of growth and into value, and that this will be led by interest rates rising. Okay, as we pull back on quantitative easing and Janet Yellen pumps the pedal to the metal to start issuing debt. It's just a massive amount of money America needs to borrow indefinitely and at interest rates that are far below the inflation currently. So it makes very little sense why anyone would want to buy those bonds unless they're a bank paying depositors interest, and they have no choice, right? Okay, so this is the energy cycle. When you have a crash and then respond to it by increasing spending at the government level and then suppressing interest rates through quantitative easing, you get these really nice bull markets in energy companies. So 2003 to 2008 was a great example of this. Interest rates rose the whole time. And then the next example of this was after the great financial crisis. Eventually, the expensive inflation or interest rates rising crashed the housing sector and created the next reset. And so we doubled deficit spending from $500 billion the last cycle to $1 trillion per year the second cycle, and repeated history. Now we got Mr. Trump in there, and they started doing quantitative tightening, so actually selling bonds into the market and raising interest rates. They definitely did not like that fellow. But what did it lead to? Another epic volatility reset. And now we've been running at not twice the deficit, but 3 times. So we've been running a $3 trillion deficit per year since the new crisis. And unfortunately, they're not going to be able to keep that level of deficit spending up next year. So we got to get worried about this fiscal cliff probably having problems by Q2 of 2022. Okay, so what should we expect when the stimulus passes? I'd expect foreign markets to greatly outperform American markets. And when we're not passing stimulus, the exact opposite, at least when we're doing quantitative easing. So here's the last 2 times we did pull off some stimulus was December with Trump and January with Biden, and emerging markets and European markets, EEM and EFA, went screaming higher, outperforming the US market by 50 and 30%. So I'd expect that exact same thing to occur. I also expect, now that we're slowing down quantitative easing and ramping up government spending again, that we should see a relative rotation out of growth into value, and that interest rates will begin to rise until they become a problem. And here's when this happened last. We had the yellow line, interest rates rising rapidly. In the candlestick, black, you can see tech stocks sold off, and in green, the energy companies went ripping higher. But then what happened? We didn't recover labor, and bond market says, okay, this growth is going to slow down quickly. We have no labor recovery. Interest rates fell. Tech giants went screaming higher, and energy flatlined. Now the markets are predicting more stimulus. Rates are beginning to rise, and we're seeing these energy plays just take off. So that's the big picture. I believe fiscal will be passed, that we are going to have interest rates rise, and that there's just a risk of volatility between now and passing that new stimulus. Okay, so we're about to jump into charts, but again, if you want to upgrade, call Dean at 505-322-7515. Okay, let's start off with the good old yield curve. So here's the yield curve, and boy, we're inverted on the 20 and 30 year, so I wouldn't make too much of that right now. Healthy yield curve is more like a skateboard ramp, so we want it to be looking more like the black line. An unhealthy yield curve is going to be more like what we see developing right now. Now we did have that 2-year come down quite a bit. That is actually down something like 10% today, but globally we saw a 2-year, it's down 9% today. But in Australia, where they removed yield curve control, they actually saw that double, 100%. So very, very interesting there. But yeah, that's in general what we're going to worry about for markets, is that as these interest rates rise, they become more and more attractive to investors of all sorts, and that's going to start to remove buying pressure or support from other assets. And so the assets that should be most concerned are certainly going to be your Teslas and Apples and Googles and Facebooks of the world, the tech giants. Likely we can basket Bitcoin and Ethereum into that same group, although they've been less correlated to interest rates compared to the tech giants. And so that's where we have the entire world extremely overpositioned, is in tech. So how much money can actually flow from growth into value? Value we're going to really identify as the banks, who love interest rates rising, increases their profitability. It's going to make them more interested in loaning. And then the energy companies do well, extremely well in periods of high inflation and rising rates. The problem is there's just not as much potential value to rotate in there before we start to stumble on ourselves. So at first, we can hedge against this inflation and rising interest rates with NRGU. But if these interest rates get too attractive, I do think it will crash commodities and the stock market in general. So we're going to be paying very close attention to this. At this point, nothing super alarming. We don't have the yield curve inverted, more in the middle of the curve. So at this point, we really just got to see what's going to happen as government starts to issue debt again and the central bank stops buying as much of it. We'd anticipate rates rise until they become problematic. And so that's exactly how we're positioned. Next chart we're going to look at is the VIX futures term structure. So we're looking at VIX futures contracts. This is a put option on the S&P 500 essentially. Very, very leveraged product. We're mainly interested in where the dots jump the greatest. And so right now, clearly it is, between November and December, and now it's starting to push into December and January. So previously it was October and November. Now we're seeing this being in the front 2 months once again. And so what is the market worried about? Well, they're worried about what the effect of tapering will be, which will be presumably announced tomorrow and begin in November. We'll see. There was room to delay it to December, but it does look like the tapering will occur. Now, again, it's not quantitative tightening, it's just slowing down the rate of QE. The other big thing is failing to pass the budget and the debt ceiling, which hits December 3rd. So these are big issues that need to be resolved really in the upcoming weeks. Otherwise, there's likely going to be a new volatility event. So we're ready for it, and we will start to get more defensive in the very near term, probably a little bit more defensive tomorrow. Okay, now if we're going to predict interest rates are going to rise, I really need to see reverse repo falling. And so that's starting to happen. We hit a high of 1.6 trillion, I believe, last week, and it's pulled back $300 billion. Okay, so this is really the cushion on interest rates. Banks cannot find enough of the short duration debt instruments in the open market to service deposits. So when you go deposit money at the bank has to pay interest, not a lot, but a little. And so they prefer to buy short-term US debt products to be able to service those interest payments. And there's just not enough available. So they're fighting over them to the point where they're now going to the Fed and saying, can we borrow yours? And so they don't mind doing that and set up reverse repo. So this is a great signal for when to get worried about our tech positions. And I think if it falls below $1 trillion and starts heading towards 700 billion, that means interest rates are going to start rising, and we're going to start to really see a serious growth to value rotation. So carefully monitoring this. Again, the stimulus is really going to allow this trend to accelerate. Without the stimulus, we're about to hit another debt ceiling crisis. So going to keep a close eye on that. Now in this, we're predicting when interest rates are coming in. And this is actually saying that July, we're going to raise rates one time. Now, I don't know if raising the rates one time is going to be a big deal, but as soon as they start aggressively raising rates, absolutely, it's going to drive interest rates up, and it's going to force money out of long duration assets. This is what would get me very bearish in things like tech stocks and cryptocurrencies. And if we remember, when crypto crashed significantly, it was exactly when we started doing interest rates hikes in 2018. So first you saw crypto crash, then you saw weak emerging markets crash, then Europe, and by the end of the year, US stock market tanked. And we'll never forget that 10-year was printing at 3.5%. Imagine that. Today, the 10-year is at 1.5%. So just unbelievable that a few years ago, you had twice the yield on a 10-year note. Okay, what if we go a little further? So it's now saying by February that we could see 3 rate hikes. Whew. I just don't see it. I believe that the bond market is getting way too uh, predictive of a successful recovery of the economy, and that they won't be able to pull this off without creating a crash. So I highly, highly doubt that we're going to have the labor recovery and economic recovery to withstand rate hikes by July of next year. So we'll see how well we can deal with tapering, and then we can worry about rate hikes as we approach July. But that's what the bond market's now pricing in. So very, very interesting developments here. Okay, so what I'm not going to do is a huge lecture on why this is the case. All you really need to know is that this absolutely is true, and so I just want to visualize it for you. What we're so worried about with interest rates, and why the bond market is really the king of everything. So here we're comparing the NASDAQ to interest rates to oil and gas zoomed in. And so you can see last time we passed this stimulus, at first interest rates rising weren't a problem. We had tech stocks and energy stocks going up. But then the rate of change on interest rates went parabolically straight up. And boy, oh boy, all the bond bears were having a field day. And we got the tech stocks to sell off about 12, 15%, nothing too crazy. And NRGU went up 100%. So that's why we have NRGU in every single strategy, because it's the only way to significantly protect yourself against interest rates rising. And again, I think that's going to be a multi-year trend that we have to face the consequences for as an investor. Now, again, they did all the stimulus and it went in and out of the economy. It didn't recover anything. Okay, the labor market's way behind where it needs to be sustainable. And then we saw what for the rest of the year, interest rates fall. Now this did catch me off guard. I didn't anticipate such a recession in interest rates, such a lockdown, such a failure of the medicine to create this slowdown in the summer. So you will see I underperformed the markets over the summer, not anticipating this, but we stuck to our guns, believing in general the economy will recover, even if it's slow, that the inflation will run hot, that interest rates are going to go up, and that we were positioned the right way, even if a little bit early. And now it's paying off in spades. So as we zoom in here to the most recent period, you can see interest rates have begun to rise again. We got a nearly 100% return from here. In fact, 100% return on NRGU in just a few short weeks. And now we're about to pass stimulus, and what comes next? Interest rates rise. Janet Yellen starts to pump debt into the market, and the Fed's going to slow down its purchases. So of course, interest rates are going to go up. So very, very interesting few weeks ahead. Russell 2000 jumping up. It's finally outperforming S&P 500. We'd expect the Russell 2000 or IWM to outperform the SPY on the upside, but also lose more on the downside. And they've been trading in tandem here. I think it's AMC is back to the top, and Avis. So some pretty funny companies dominating the Russell 2000 due to short squeezes. Russell 2000 has been trading pretty flat all year and starting to break out now, which is what we were predicting would happen. And again, pass some stimulus, and these are just going to take off for the remainder of the year. That's why we're being so reluctant to get bearish. Now, emerging markets has been having all sorts of problems, food shortages, energy shortages. We got China started off taking out of all things, the private schooling sector. They didn't want the parents spending a bunch of money and time on private schooling. Then they went and allowed a bunch of big real estate developers to collapse because the housing was becoming too expensive, is slowing down the tech sector. Then they started attacking the tech sector with Jack Ma getting shamed. They took away his insurance company he was launching. What did they do next? Then they outlawed video games for children. They're only allowed to play on Friday nights for an hour. They've been taking out all sorts of uh, gay and lesbian chat rooms, all sorts of weird, weird restrictions happening in China, jailing all the threats to President Xi. But again, this has been on the backbone of their strongest economy in history. So I believe they're really taking advantage of this strength to clean up their act. And their goal is to certainly take the lead economically, probably this decade. So I believe Ray Dalio is correct, and this is your best ETF. The chart would make you think that's nonsense. I'm getting ready to increase exposure to Asia with emerging markets, or we use the ETF EDC soon. So that'll be in the pro strategy where we have that exposure. Okay, in this chart, we're comparing Bitcoin to Ethereum. And so in general, we see Bitcoin jumps, then Ethereum jumps even more, and then altcoins come in next. On the opposite spectrum, when we're in a bearish market, we're going to see those altcoins fall off a cliff and the opposite reaction occur. So Goldman Sachs is now predicting Ethereum hits $8,000 by end of the year. So pretty remarkable. We've had a big bet on that in our high risk strategy. Our Bootcamp core has been big on Bitcoin. I like combining the two. I do like to hedge my Ethereum with Bitcoin and my Bitcoin with Ethereum. And if you want to take it a step further, I'd be looking at Ethereum's main competitors. And so their competitors have 1/10 of the market share. So if you're looking for the next 10-to-1 return, consider the potential of Cardano, Solana, or Polkadot being able to actually gain on Ethereum and outperform it because they have 1/10 the market cap. And these are already up tens of thousands of percentage points. So we do have a private equity deal that can get you some exposure to that. But we saw Bitcoin break to a new high. We've now seen Ethereum break to a new high. A lot of these altcoins that compete with Ethereum are yet to do that. So in that product, I'm getting ready to load the boat in specifically those three, Cardano, Solana, and Polkadot. And my main take on the blockchain space is that there must be a successful operating system. That's why I don't pay too much attention to Shiba coin or Dogecoin, or there was Squid Game coin that went to it went up 300,000% in a week, went to zero yesterday. Okay, so I'm looking at where is the technology that's going to disrupt businesses coming in that has the strong user growth. And so we absolutely must come up with a blockchain operating system that succeeds. And there's only a few people that are really trying to make that happen. That's Ethereum, Cardano, Solana, and Polkadot. So when you play all of them, you know one's going to walk away the winner. And that's the way I'm focusing our investments in cryptocurrencies. Okay, gold and silver have just been so pathetic. Just really, really interesting to see how poorly they've performed in 2021. We were betting big on them in 2020, and that did work out well. But it's mind-boggling why they've been so pathetic. So you could presume that the market's saying we have a really strong economic recovery led by labor, and that's why gold and silver, the stagflation play, is not picking up steam, and that Bitcoin and Ethereum are more of an inflationary hedge similar to oil. And we've actually seen a weird correlation that when gold's going up, Bitcoin's going down. So they're not behaving as the same thing. They're behaving as stagflation versus inflation. So very interesting. So essentially more like a tech stock for crypto, which makes sense because it is a technology. Okay, next we have our potential defensive plays. If we're going to crash, I like 3 products. EUO, that's the dollar versus the euro. Safe place to put cash and wait on the sidelines. And if there's a crash, you make a okay return. You're not going to get rich. TMF is a triple leveraged long duration US Treasury play. So it's the TLT times 3. There's a record short position on the bond market. And if we have another debt ceiling crisis, TMF is going to skyrocket. So I'm getting ready to start allocating a little bit to TMF as soon as tomorrow, while topping off on UVXY. And the closer we get to the end of November without a deal, the more aggressive I want to get into these three plays. So I like treasuries, but again, in the long term, treasuries are not a good deal right now. Their interest rates are far below inflation. There's no reason to think the inflation is going to go away anytime soon. It's really just a short-term debt ceiling crisis that could give us a quick return on TMF. The ultimate hedge will be UVXY, which is also the most painful to hold, as you all know. But perhaps the day of reckoning is coming for a big return on UVXY. Likely tomorrow, we will, at a minimum, slightly increase UVXY and maybe add a little bit of TMF. I'm not ready to get super bearish, but I do want to start pulling off some of the offense and preparing us for a crisis if they can't get their act together. My best guess is they do pass this bill and that we don't need to get defensive at all, and we're just going to melt up through March. But Joe Manchin and Giant Paul are just not coming to terms, and Pelosi's lost control of this entire negotiation. Meanwhile, Biden's popularity has sunken, so it's looking like Giant Paul sees an opportunity to take power right now. So we just need to be a little bit precautious. Okay, in Bootcamp Core, we have some alternative plays. We like TAN for solar energy. This is this whole idea of going green and getting carbon emissions to zero is really, in my opinion, impossible without some pretty draconian government regulation, which China and Russia are not participating in. And they are really the main ones that need to lead this. And if we're about to have a red sweep in the midterms and potentially in the election, I'm less interested in some of these alternative energy plays. But assuming the current powers that be control policy globally, I love FNGU, that's tech stocks, with a little bit of Asian tech stock in there. So you get Alibaba and Baidu with 10 US giants. I love rare earth metals. Regardless of politics or who's in control, that's going to give you exposure to lithium and cobalt. So your Teslas and Apples can't get enough of that. Massive shortages ahead in rare earth metals. So REMX I like no matter who's in control of the government. TAN, much more interested when we have globalist agenda. That's your solar panel, your solar and wind power energy alternatives. If we're going to go green, it's got to be with nuclear power. I do think that's going to be a big trend for the next several decades. But again, probably more with globalists in charge compared to populists. So URAs are play on that. Uranium. Copper miners has a beautiful multi-decade play ahead, regardless of politics. COPEX, we love that position. And then the biggest dud for us this year has been MJ, the medical marijuana play. So I'm wondering if the stimulus will get this stock buying. Now, MJ tends to be a real dud and then suddenly it goes skyrocketing on stock promotion. So we've been very patient for that to occur, but so far it's just been doing nothing but sinking. So those are the alternative plays we have in the Bootcamp core portfolio. All right, in the next chart, we're going to check out the dollar. So the gains we've had that were really attractive in October were just from the dollar falling from 94.50 to 93 at a low and bounced back up, and we've still held all those gains. Just wait till the dollar falls back to the 89 to 90 level. Okay, your NRGU position is going to go screaming higher. Your crypto position is going to go screaming higher. Your emerging markets position is going to go screaming higher. So that is at the end of the day what I believe will happen, and when I'll probably pull some significant profits out of our most aggressive inflationary bets, betting that there will be intervention to prevent the dollar from going below 90. But yeah, just remarkable to see the gains we picked up last month just from that tiny move. Now, what's the catalyst? Stimulus. Stimulus is going to make the dollar go down. Here's that Chinese currency. Again, just massive strengthening. All this fear mongering about China and their currencies, just strengthening. So nothing to get concerned about there. Here's your NRGU play, which has been just parabolic from really since the crisis. But you can see it's been very volatile. Now, a lot of people like to focus on technical analysis of a leveraged product, and I'd say that's very misleading. We're going to be more interested in ExxonMobil. And so if we zoom out a little bit and put things into perspective, it's still cheap. Okay, these energy companies are going to make more money than they've ever made in the history of their companies as the demand for oil is accelerating. And there's really no sign of relief from clean energy to reduce this. So as soon as Exxon breaks this 100 level, I'll probably get very worried. I do think it will break that high of 2014, and that'll probably be when the dollar is getting close to 89. So we'll see how long it takes. But yeah, there's a lot of upside in NRGU, which is a leverage play on Exxon and all the other big US oil companies. So again, if you're focused on a leveraged technical chart, don't. Look at the underlying, look at the valuations, look at the price of oil, the trajectory of oil. What's going to slow it down? Only thing that'll slow it down would be rate hikes. And I don't think the economy can handle that because we haven't recovered labor markets. All right, so if you are interested in our private equity offering and want greater exposure than just Bitcoin and Ethereum, the plays I'm interested in are Polkadot, Polygon, Solana, Ethereum, PancakeSwap, Cardano. We're just looking at the recent returns on these other assets so you can see what you're missing out on. Polygon up 51%, Polkadot 48, Solana 43, against Ethereum at 25, Bitcoin at 10. Your hedge flat since the 13th. PancakeSwap, which remember pays out a 72% interest rate just to buy and hold it. So what a return, even if it just trades flat. Now it's trading at a massive discount from its high in March. So this one could end up being our best returner of all with the staking reward plus the potential gains. PancakeSwap is the DeFi similar to Uniswap of Ethereum, but for Binance. And Binance getting kicked out of countries all over the place. Great news for PancakeSwap. That means you can sneak around your government and get those coins that nobody else is allowed to have by going to the DeFi exchange. So we love that. And again, the idea is Ethereum could overtake Bitcoin, but Ethereum has competitors that could overtake it. And so it's good to have that entire mix and not really bet the farm. All right, so the big story I believe that's going to develop is that we're about to see cases start to rise in the United States and overwhelm hospitals. And I'm going to say it's going to be the start of December when it becomes very overwhelming, and maybe the last week of November. So that's what we've been anticipating. We've seen the rate of change of cases falling, which is predictable based on seasonality. And now we're going to anticipate it's going to start to rise again. And that's what we're starting to see right here. You can see the rate of change of cases starting to rise again. Seasonality for US is the last week of November and the full month of December is when we get hospital cases that are 2 to 3 times the normal average. So could this be used as a political weapon to force policy through? I believe it could if necessary. So that's going to be the main data we're going to be watching and anticipating as we head into the end of the year. All right, this chart, we're looking at oil versus rates. These two tend to be tied to the hip. If rates go up, oil goes up. We can see from this point on, they have not been tracking one another. Right here, we have a similar move. Oil pulled back, rates pulled back. But then oil went back up and interest rates have been fighting this. What's the catalyst? Again, you in QE. So that's going to help rates rise, less buying of the Fed. And then you pass stimulus. Those are the 1-2 combo punch that will likely make interest rates rise. So I do think we're on the verge of interest rates catching up to oil and not oil crashing to interest rates. Now, again, you've failed to pass Build Back Better, infrastructure, and lockdown. Well, guess what? Rates are going lower and oil's going to tank and be our best gauge of when to get defensive. Okay, copper keeps going up, up, up. This is copper futures. Lumber had crashed and then risen, so we'll pull back. So this is that epic run up to lumber futures went to 1700, crashed down to 500, rose back to 800, dumping to 600 today. We got the Baltic shipping index crashing right now too. So we're starting to see some signs of deflation and a slowdown of demand. We're not seeing it in the price of oil. But some of these weaker, more volatile and less liquid markets are certainly losing the bid. And so without the stimulus, I do think you will see oil fall. So that means NRGU could be in trouble. Here's that Baltic dry index falling. Now here's a look at interest rates since the 80s. And the main thing you need to realize is the only way the US government stays above board and keeps all its obligations paid are these interest rates go down over time. So my bet is that if we pass stimulus, you will not see the 30-year go above 3 without crashing the global economy, and the 10-year likely will stay below 2.4. So if we break this recent high of 2.4 on the 30-year, I will be a very happy buyer of bonds, expecting that it will provide no more drawdown than hitting the 3 and then crashing everything and causing QE and a huge gain in the bond market. And that in general, this will head to 0 in your lifetime, just like we've seen in Japan and Europe. And again, that's because that's the only way the government can expand its debt. Okay, unless we think the US government's going to stop expanding debt, stop paying all of its promises to the American voters, then this must go lower over time. And so if we fail to pass stimulus, there's a potential for this to short squeeze towards where we had these recent lows. You can make a lot of money on that in a very short period of time. But in general, if we pass the stimulus, I expect these to begin rising until they create problems in the economy. So as soon as they break this level, I will start accumulating these for our clients. If it looks like we can't pass stimulus, we'll start accumulating right now. Okay, Dr. Copper is a pretty popular way to predict interest rates. Copper is used when we're building stuff. Gold's used when we're worried about the value of money depreciating. And so the ratio of those prices is very good at predicting interest rates. And so in general, this has been predicting rising rates, but it's been cooling off in the last few weeks here. So we'll see. I believe this is about to jump higher on the catalyst of stimulus. But we've got 3 critical bond markets we track: TLT, LQD, JNK. If any one of these is falling, that means rates are rising either for corporations or the government. Either way, it's not a good sign unless you have robust recovery in the economy, which we don't. So we really don't want to see rates rising right now because there's a very uncertain policy for stimulus, and there's essentially no labor recovery for 2 months straight. I believe we're about to have 3 months straight, very little labor recovery. And I actually think it's going to be weak for the rest of the year due to sickness picking back up, which has been highly correlated to job recovery. Okay, Janet's back at starting to raise some money, but she's going to hit her new limit again. So McConnell threw him a bone to fund the government to December 3rd, but then we're going to be locked out again. So this is going to become a problem. But we're starting to see reverse repo fall. Here's the last 2 months of jobs. So we've had a few really good months, but in general, they were really promising 500,000 to 1 million per month, and we've hit that in 4 out of the last 10 months. The other months have been pretty weak, especially the last 2. And with the mandates, I don't see a strong print. I think they're estimating below 350 for this month. So we'll see. That's not enough. Okay, core inflation rate, we predicted would be flat or down this month, but then rise next month. Because now we've got energy, wages, and rent all coming into the picture. It's going to be sticky for a prolonged period of time. In general, that would force the Fed to raise rates and stop QE. But again, they haven't recovered the labor markets, and that's probably going to hold them back from getting too hawkish. Bank credit's rising, so that is good for the way we're positioned, predicting rates rise and a slow recovery. Consumer credit's continuing to grow. Retail sales continues to grow. Consumer spending just hit a new high. Here's the shape of it, but it is flattening out, but still at very high levels. Record job openings. The PPI, so the cost inputs for companies, keeps growing, but that's been growing at about 0.5 to 0.3 per month relentlessly, and even more aggressively earlier in the year. So that's the inflationary problem not residing. Jobless claims continues to be below 200,000. I get impressed, but again, people are coming in and out of jobs, looking for higher paying wages. Earnings are now picking up. They're below inflation, but the wages are typically going to come in after inflation, not before, of course. Now, if we want to believe that inflation can last and last a long time, like the 70s, then we need labor force participation rising. So it's not even back to the 2020 level, and it's really just flatlined since July. So no reason to believe that we're going to have long-lasting inflation that the economy can sustain. Balance of trade, this is important for predicting the dollar. This keeps getting bigger and bigger. Negative trade balance weakens the dollar, throw in the deficits, you get the double whammy to push that dollar lower, which again is how we're positioned. We did get a drop in personal income. A lot of the bond bulls, excuse me, have been predicting that as the government free money comes to an end, that incomes are going to fall off a cliff and create a earnings per share crisis for corporations. So far, that's just not happening. Now, we have had some problems with Amazon and Apple having profit margins reduced or chip shortages slowing them down. So we're starting to see some warning signs in the inflation front. But meanwhile, Apple's sitting pretty, nothing to get worried about there. Tesla has had record option volume. Elon's now, this is now worth, I think, 3 times Berkshire Hathaway. Mind-boggling valuation. They're predicting what Tesla is going to do in a decade to value it today, so totally silly. And I'm a big Tesla Elon fan, so take that with a grain of salt. ARK funds sold Tesla way too early, and all she can talk about is whale oil and how we're about to have a deflationary shock that's going to wipe everybody out. I love to buy ARK funds once it crashes probably back to these levels. I do think ARK funds are in for some serious pain until about 2023, when I think we're going to see significant tightening, and that's after the midterms. I don't think we're going to have the political appetite to allow the Federal Reserve to crash the economy with hawkish policy in a weak labor recovery until after the midterms. So if interest rates rise, as I suspect, ARK funds are in trouble. There's too much money in this fund. So this could be problematic. Tesla or ARK funds selling off violently could create systemic risk. So they're now both on my radar and have been. Okay, in China, we like a few big tech companies. Tencent is one of them. If it's not owned by Facebook, it's owned by Tencent in terms of phone apps. Huge portfolio and trading at a huge discount. If I had to bet on one stock, I really like, as far as a value play, I like Tencent and Alibaba a lot. And you get tremendous exposure to that with EDC and the Pro strategy. Both have been smashed down by their government. Okay, Samsung, we've been keeping an eye on. It's been falling for the entire year, starting to stabilize here. Then we've got Toyota back near a new high. So no big warning signs anywhere. China's composite PMI jumped. They had some that were falling, but in general, still back to positive territory. European PMI back to positive, still at positive territory, but falling. Chinese imports hit a new high. Chinese exports hit a new high. No sign of a demand shock anytime soon. China's currency has been strengthening, so they're not seeing a lot of inflation on that front, although in energy and food, they sure are. US just hit $8.5 trillion in its central bank balance sheet. European central bank balance sheet just hit a new high, big jump. So we'll see if they're really going to taper and how the market's going to handle that. But bottom line, I'm calling a top by next summer, and we will get defensive because they're going to have huge fiscal cliff, interest rates rising, the risk of rate hikes coming in, plus the end of QE. So unless you give me 1 million jobs a month from here till summer, I do think we hit a short-term top in our inflationary cycle by next summer, and then we're going to need more stimulus to keep the party on. So that's the way we're looking at the markets. Let's check out the news. Here's the profits of Berkshire compared to Tesla. Tesla made 7 billion, while Berkshire made 147 billion. So again, just Tesla's become a mania. Yahoo's pulling out of China due to challenging business environment. Now people are predicting that rate hikes will be inflationary because banks will be more interested in lending money, but at least it will be healthy lending instead of just the government throwing money out the door. So again, we're positioned for that. Governor race in Virginia, this would be a huge upset and could be telling for midterms. So we'll see how that plays out. Ammonia, key input for nitrogen, is going parabolic. So we're predicting food spike coming in, food inflation. Manchin says he's working to refine the Biden plan, not kill it. So we'll see how that plays out. We've got a bunch of NASA scientists saying they do not want the medicine. Interesting letter. We had Los Alamos Labs, a bunch of elite scientists don't want to do it. It's funny, it's actually by education level, PhDs are the most medicine hesitant. Very interesting. If you want to read that letter, it's right here in my Twitter feed. But again, why we talk about this? Mandates slowing down the economy, the labor markets, timing of rate hikes and tapering, as well as policy. That's why we're interested in this sort of social news. Okay, I'm going to take a quick look at the chat box here real quick. Oscar says, why is Avis jumping like a Robinhood stock today? Yeah, it's the Reddit crowds all over. I don't follow the individual names too much. George says, how long do you have to hold the pancake swap? Not very long. You can get in and out. Some people are, Kevin's commenting on Bitcoin, replacing gold, driving Peter Schiff crazy. Jeff says, what's the corporate bond rate and how does it affect? They're low. Yeah, they're really low. I think 2 to 5%, depending on what type of company you're lending money to. Karen says, remind me, why does crypto crash when interest rates rise? Yeah, crypto's really trading very similar to Tesla or the NASDAQ. Not 100%, but very similar. In general, these products are pricing in growth into the future and low interest rates to get there. So if the interest rates are rising, we see those types of investments really falter. But yeah, Bitcoin's hasn't been 100% correlated to tech stocks. So it's only a decade old. We don't have a lot of firm correlations for crypto and other assets. In general, though, if bond yields are going up, it's going to be like a black hole sucking up planets and universes all around it and just gobbling it up until it's happy. So interest rates are certainly the biggest problem for everything in financial markets if they start to rise rapidly, especially with US very popular debt instruments as far as treasuries. Steven says, what does Jason mean by Australia letting go of yield curve control? They stopped forcing yields to be lower and their 2-year went up 100% or 200%, something crazy. So that's a warning sign that perhaps the Fed slowing down its QE, we could have rising rates that are faster than people are anticipating. Yao says, is ETHE still a buy? Free recommendation. Yes, it is. Yes, it is. Michael says, Ola from Cleveland. Yeah, so you know the story, my man. If it's on the trading plan, it's a buy alert. So, yep. Okay, very good. We'll continue. Politics, a new poll from NBC about mandates, not popular. So again, we're interested in populism versus globalism, and which party's more in that focus and how that's going to affect policy. So if you're in the populist red group, things are looking good for you, for sure. Maybe we'll see. We'll see what happens with voting and mail-in voting and all that. The Virginia race will be very telling for sure. If that can be flipped red, that would be very interesting. Okay, so for those of you guys who've been writing me about holding Tesla, we're starting to see the reverse repo fall from 1.6 to 1.3. I've told you I'll get more worried once it cracks $1 trillion and heads towards 700. So at this point, nothing to freak out about. I think the stimulus passing will make that reverse repo fall within the next couple of months. So I think we're coming into a top on tech. We're going to see the tech rotate into the value until we get the top, and then we're going to see that oil fall to create a real deflationary crash. So tech falls, oil keeps going up, energy keeps going up until the prices become unsustainable and demand crashes, and then oil leads the way down for the big crash. So I'm not really thinking we're going to get a big crash right now unless we fail to pass stimulus and do a lockdown. You do both of those and certainly you're going to get a problem. Here's some fellow trying to value Tesla at $2 trillion. So if we can sell a car for $45,000 and sell 20 million cars a year with a 20% margin, you get to a Berkshire Hathaway in profits like you have currently. But again, that's like a decade away from even possibly happening. So, so probably not going to be able to hold that valuation for much longer, maybe 6 months at the most. China's urging families to store up food for the winter. They've been demanding all their companies get a hold of as much energy as possible. So we might have a pretty crazy energy shortage this winter. We'll see. Peter Atwater says, what people remember from the late 70s gas crisis isn't the price of gas, but the fear they felt sitting in line praying there would be any gas left when they finally got to the pump. Elon Musk making fun of, I think it was, let's see who it was. This guy cracks me up. Attacking Dr. Fauci. Big no-no. Yeah, he is not popular. And it appears he's not popular with the global elite. So we know, anyways, we won't get into too much of that. Ireland has record cases right now since January. 95% of the population has taken the medicine. So how do you explain that? Wheat surges to $8 a bushel. So food inflation is coming in right now. All sorts of people calling in sick with these mandates coming up. This is the guy stopping the new spending. How long will this go on? Here's a look at the household deposits skyrocketing in 2020 and 21. So there's still a lot of money to be spent. That's why I'm not freaking out, even though we see all the government subsidies coming to an end. Okay, we'll end here. So right now you get Bitcoin and Ethereum at a discount with Grayscale Trust. And these discounts have been shrinking. So we can actually outperform the underlying for a little longer, and they are applying for the ETF. GBTC is in Bootcamp core, 30% or so position. The high risk is loaded to the brim in Ethereum, something like a 60% position. So, okay, very good. All right, guys, I'm going to go ahead and do the little pitch to upgrade, and then we'll go into the exact asset allocation. All right, guys, so if you're, again, catching the replay, you're going to miss the ending of this video where we reveal the trading formulas. So call Dean, upgrade 505-322-7515. We're actually going to do a trade alert tomorrow for sure, small one. And then we'll probably do another trade alert November 15th-ish if we haven't seen some progress with Mr. Joe Manchin. And then we'll get even more defensive before December 3rd if they still haven't gotten their act together. And we don't see signs McConnell's going to increase the debt ceiling. So if the debt ceiling isn't increased by December 2nd, we're going to have a complete shit show. So call Dean. This is probably the most important month you could possibly have in my advice if things don't go right. So call him at 505-322-7515. Okay, very good. So we're going to now jump into the members only content.